Most business owners think they understand cash flow because they check their bank balance every day. The problem is that a bank balance only shows where you are right now. A cash flow statement shows where your business has been and where it may be heading. In this video, we are sharing 7 cash flow statement mistakes to avoid. 1. Celebrating revenue while cash is disappearing. One of the most dangerous mistakes in business is assuming that growing revenue automatically means improving financial health. Imagine a company that doubles its sales within a year. On paper, everything looks fantastic. Revenue is rising, customers are buying, and the owner feels successful. But when they open the bank account, cash is actually lower than before. How can that happen? The answer is that revenue and cash are not the same thing. A business can make sales today and receive payment much later. It can also spend cash faster than it collects it. Many companies become obsessed with top-line growth while ignoring the cash required to support that growth. They hire more employees, increase marketing budgets, and purchase additional inventory. Revenue rises, but cash quietly disappears in the background. The cash flow statement reveals this reality. It shows whether business growth is actually producing cash or simply creating more financial pressure. Smart owners celebrate revenue only after confirming that cash flow is moving in the right direction as well. 2. Treating unpaid invoices like money in the bank. Many business owners look at outstanding invoices and mentally count that money as already received. They assume the cash is practically theirs because the work has been completed or the product has been delivered. Unfortunately, customers do not always pay on time. Some pay late. Some require multiple reminders. A few never pay at all. The cash flow statement helps expose this problem by separating actual cash received from expected future payments. Imagine having a large amount of unpaid invoices while payroll is due next week. On paper, the business may appear profitable, but profitability does not help if cash has not arrived. This mistake causes countless cash shortages every year. Successful business owners understand that an invoice is not cash until the payment is sitting in the bank account. They monitor collection times, follow up quickly on overdue accounts, and avoid becoming dependent on money that has not yet arrived. The cash flow statement reminds them to focus on reality instead of assumptions, which greatly improves financial stability. 3. Letting inventory become a cash trap. Inventory often looks like an asset, and technically it is. However, inventory can also become one of the biggest cash traps in a business. Many owners believe that buying more inventory automatically prepares them for future growth. While that can sometimes be true, excessive inventory locks valuable cash on warehouse shelves. Imagine purchasing large amounts of products because demand might increase in the future. Months later, sales move slower than expected. The inventory remains unsold, while cash that could have been used elsewhere is trapped. The cash flow statement reveals this issue because it shows how much cash is leaving the business to support inventory purchases. Businesses often experience cash shortages not because sales are weak, but because too much money is tied up in products waiting to be sold. Smart owners regularly evaluate inventory turnover and focus on maintaining healthy stock levels. They understand that inventory should generate cash, not consume it. A growing warehouse is not always a sign of success. Sometimes it is a warning sign. 4. Mistaking borrowed money for business performance. Receiving a loan can create a temporary feeling of financial success. Suddenly, there is more cash in the bank account, bills can be paid, and immediate pressure disappears. The danger is that some owners begin to mistake borrowed money for business improvement. The cash flow statement separates financing activities from operating activities for a very important reason. Money received from lenders is not the same as money generated by customers. One represents future obligations while the other represents actual business performance. Imagine a company that constantly relies on loans to cover normal operating expenses. The bank balance may look healthy, but the underlying business is not producing enough cash to support itself. Eventually, debt payments begin to accumulate and financial pressure returns. The cash flow statement helps owners distinguish between cash created by operations and cash created through borrowing. This distinction matters because long-term success comes from generating cash through customers, not through lenders. Smart business owners celebrate strong operating cash flow far more than temporary boosts created by debt. 5. Ignoring the cost of growth. Growth is exciting. More customers, more sales, and more opportunities sound like positive developments. However, growth often requires significant cash before it generates meaningful returns. This is one reason why many fast-growing businesses experience financial stress despite increasing revenue. New employees must be hired. Inventory levels may need to increase. Marketing campaigns become larger. Equipment upgrades become necessary. All of these investments consume cash. The cash flow statement helps reveal whether growth is strengthening the business or placing excessive pressure on finances. Imagine receiving a flood of new customer orders while lacking enough cash to fulfill them properly. Growth suddenly becomes a challenge instead of an opportunity. Many owners focus entirely on sales targets while ignoring the cash requirements needed to support expansion. Successful businesses plan for growth financially before growth arrives operationally. They understand that growth without cash can become dangerous. The cash flow statement acts like an early warning system, helping owners identify whether expansion is creating value or creating financial risk. 6. Forgetting that equipment purchases drain cash. Purchasing equipment often feels like an investment rather than an expense. In many cases, it is an investment. New machinery, vehicles, technology systems, and production equipment can improve efficiency and support future growth. However, these purchases still require cash. Many owners focus on the long-term benefits while overlooking the short-term impact on cash flow. Imagine buying expensive equipment because it will increase productivity over time. The equipment may create value for years, but the cash leaves the business immediately. If several large purchases occur close together, the company can experience a serious cash shortage even while making smart strategic investments. The cash flow statement highlights these investing activities and shows exactly how much cash is being committed. This visibility is extremely important because timing matters. Smart owners evaluate major purchases not only based on return on investment, but also based on their effect on cash reserves. A great investment made at the wrong time can still create financial stress. Cash flow helps determine the right timing. 7. Using last month's numbers to make today's decisions. One of the most common mistakes is treating financial information like a history lesson instead of a decision-making tool. Many owners review their cash flow statement once a month, look at what happened, and then move on. The problem is that business conditions change quickly. Decisions made today should be based on current information and future expectations, not solely on last month's results. Imagine driving a car while only looking in the rearview mirror. You would know exactly where you have been, but you would have very little understanding of what is ahead. That is how many businesses operate financially. The cash flow statement becomes most valuable when combined with forecasting and forward planning. Smart owners use historical cash flow information to predict future challenges before they arrive. They identify seasonal patterns, upcoming obligations, and potential shortages early. This allows them to take action while options still exist. The goal is not simply understanding the past. The goal is using financial information to create a better future. The biggest lesson from all 7 mistakes is simple. Cash flow is not just an accounting report. It is a decision-making tool that reveals the true financial condition of a business. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.